I'm Simon.
And I'm Simon.
I've been investing in property for over 20 years, and if you're an active landlord or planning your next property investment, this podcast is for you. Simon Glastonbury is an independent mortgage broker with 25 years of experience providing mortgages, bridging, and development finance for home buyers and investors. I really do hope that you find today's episode useful and interesting, and if you do, we would very much appreciate it if you could tell a couple of other property people about this podcast. Now, today, Simon Glastonbury is joining me to talk about a range of mortgagee sort of topics, including obviously the Bank of England and the recent rate change there. But we will also talk a little bit more widely about the mortgage market and also about some of the budget impacts on the housing and mortgage market. And then hang around to the end where we will have a quick fire roundup of some of the current mortgage rates you might be able to find out there if you're looking at, taking on new finance. So back to the beginning of that list, Simon. And last week, as we record, and actually as this episode goes out, often we record the week before it goes out, but this week we're recording the same week this episode is going to go out. So it's still just a few days after the Bank of England announcement, though, and they reduced the base rate. So do you want to give us a little summary of what happened and what you think it means?
Absolutely. As expected, as we were talking about, and good job we did sort of, they did lower it because we delayed the podcast, just because. But good news, it was expected. We were looking for this for some time, so which is good news for the investor. It's good news for anybody looking for a mortgage, anybody looking for refinancing. So how the knock-on effect is, the questions we're getting asked on a daily basis is, well, what effect is it having on me? As you can imagine, we got inundated with calls immediately afterwards. Can we get rates? Can we get refinance? Can you change my mortgage offer I've had sitting around at the solicitor's office the last 2 months? Simple answer to that is yes. In most cases, which is a slight side issue, but something I would touch on because it is a question I'm asked all the time. Pretty much up to exchange of contracts, I would say, ask your broker to change your rate or look at the rate again if they've not done so on a regular basis. We as a business will do it all the time. The diary notes are coming out constantly at the moment because we're expecting them to fall. And banks all the major lenders are reducing the rates throughout. I'll put a caveat on that because there are a couple of the larger lenders who've come out immediately after the base rate cut and said they're increasing rates up. Santander, to mention one of them. So they're not on my Christmas card list at the moment. But a caveat, like I say, if you have rates and you're sitting on offers, what I would do is go straight back to the broker and say, are they available yet? Now, how long does it take is the big question. Bank of England base rate was cut last week, as we know. Great. The expectation is there is quite possibly another rate coming before Christmas. Fingers crossed. That would be very nice for all of us. And when will it knock on? When are we going to see the rate cuts? It usually takes the banks about a week or two to then rebuild the products. They've got to, as you can imagine, they've got to get the marketing material, etc. They've got to change all the systems. They've got to tell all the software companies, the people we use, to change all these things around. It doesn't happen very quickly. They can withdraw them very quickly, of course, and they do. But generally speaking, it will be a week or two before we'll start seeing the rates coming down. But sort of not going on from that, and our conversation when we had last time, which I think was probably about 6 weeks ago, because I know we've delayed it for this, in the hope that the Bank of England did the right thing. Rates have come down. They are pretty much across the board, circa 0.5% down from where they were at that time. So on a lot of the sort of residential sort of fixed rates, there has been a bit of a difference in the buy-to-let market and the investor market. We were talking, I'll touch on that. They've gone away from a lot of lenders have gone away from the very high fee product. Now, whether that is something to do with rates now dropping because of Bank of England and what they're doing, and a knock-on effect of that. They don't have to reduce the rates right down, as we discussed before, to get the stress tests within certain parameters. I don't know. That may be the case. We can only sort of speculate on that one, but it does mean that rates are coming down. It does mean for the buy-to-let HMO landlord, portfolio landlord, that rates are becoming a little bit more realistic, or where we like them to be. But yeah, we haven't as yet. We're only a few days after the Bank of England has made the announcement, so I wouldn't be expecting seeing any rate drops as of yet. Next week after, yes, that's where we're going. And however, another caveat I put in there: if people are looking into the data in detail, they're following swap rates. Most of these are sort of, banks are building these in. They will know what's around the corner, or the expectation of what's around the corner. So all of these rates are built in anyway. They know where they're going to be. Are they going to drop? Don't immediately, as a consumer, think Bank of England dropped 0.25. My fixed rate I was looking at last week is going to drop 0.25. Fortunately, it doesn't work like that. Tracker rates, yes, potentially. You will follow. It does follow the Bank of England base rate, but fixed rates, no. So hold your breath on that one a little bit at the moment.
Yeah, I've heard, or I've seen headlines saying that mortgage rates probably won't fall because everyone's built it all in anyway, and of course they could be talking about sort of standard variable rates, which are up at 8.5% or something silly, or they could be talking about the fixed rates, which are a lot more reasonable, but generally are actually already below-ish the Bank of England base rate. So it's, yeah, I don't know. I mean, we should actually say what was the rate and what is the rate. I don't think you've said that so far. So
the Bank of England. Oh, sorry. The Bank of England is now dropped to 4.75. So you're right. The fixed rates are well below that. And the interesting thing, if you're then going into a little bit more detail about swap rates and where they are and what's factored in with the banks, we can have a separate conversation about swap rates. We can go into them in a lot more detail. That is something if you want to get a little bit geeky about rates and where they're going. But for the banks, it's interesting that the 2-year fixed rates are still higher than the majority of 5-year fixed rates. Now, I would probably put my hat on the fact that I've never seen that. I mean, we've had that for a while now. Sorry, we've had that for. I would probably expect that about a year. I'm looking at rates going back. Yeah, I mean, February last year, December last year, it was the same. So about a year we've had that, which is highly unusual. It's usually the 5-year rate historically is higher. So what I'm seeing with there is the expectation for the bank. They're factoring that money in, which they're lending at a lower rate at 5 years. They don't want to commit to a lower rate at 2 years because, for whatever reason, whether they're expecting rates to go down, whether they're expecting rates to go up, they're the figures they're factoring in. So it is getting closer. They're getting the 2-year rate is getting much better. They're much closer, pretty much across the board, whether it's buy-to-let, whether it's residential. So they're close to meeting. Whether it changes, only time will tell. But it's an interest factor in the marketplace at the moment. But yeah, I mean, it's the base rate with coming down. It definitely will affect the market going forward.
Good to hear, I think. So how is the market at the moment? Are things still moving? Is it still all alive? And are you busy?
Yes. The good thing for us, and we are a tiny little cog in the mortgage world, of course. But obviously, we speak to people. I've been around the business for an awful long time. We speak to people all the time about the market, and generally speaking, people are getting much busier. Now, that does come from a point from being pretty quiet. So it's a little bit, it's a bit like Halifax when they come out with their house prices saying, oh, they've gone up again. Well, they didn't actually mention they'd fallen for the last 6 months in a row. So you only tend to get the good news. I'd like to be quite upfront and say, well, it's been a fairly quiet sort of 18 months or so since interest rates have risen, because people have been waiting. People have been waiting for the market to change. Now I get the feeling on the both sides, on residential and also investor side, people are becoming used to these rates where they are. Are they going to drop? And the realization is, I don't think they're really going to drop that much more. Possibly, but if you're looking to buy your new home and the rate is around 4% at the moment, that's a very sort of a rough figure. But if you're looking at that, is it going to drop to 3%? I doubt it. I doubt it very much, or certainly not anytime soon. So if it's not, and it's likely, then it may drop to 3.75. It may drop to 3.5. You're not saving an awful lot of money, and are you sort of biting your nose off to start to spite your face and not moving house at this time? Same with an investor. If you're an investor and if you've got money burning a hole in your pocket, which is a lovely problem to have, are you just keeping that money in your pocket, or waiting and waiting for something which may or may not happen? And from what we're told and from what banks are factoring in, we're not expecting a huge drop. And I think that then goes out on a marketplace, and we can see that the purchase market is certainly more buoyant. The investor market, definitely people are looking different areas. And we'll touch on to the stamp duty issue in a while, but it's definitely good news. It's definitely good news for the market. And we were talking between the team, and it looks like 2025 is going to be a much better year, because people have been waiting and waiting to move. They're not ready. We're seeing a few more properties on the market, not a great deal, but a few more. And I think that people will be ready. Think, right, okay, we're not waiting anymore. We're going to move, or I'm going to buy that buy-to-let, or I'm going to add to the portfolio. Let's look at refinancing. Let's move forward, which is good news. It's about time.
Yep, indeed. So the Bank of England bringing the rate down is positive, and generally it sounds like the market is feeling quite positive. I know there's always a little bit of a slowdown towards the end of the year, but hopefully that hasn't hit too badly yet. And you've got a positive outlook on next year. But there was that sort of slight spanner in the works of the budget. and I think it was actually a lot better than many people thought it could be in all sorts of different respects, in fact. But there was a stamp duty increase, and there was one implemented the next day. And I have heard lots of people saying, oh my goodness, my chain's at risk, and I can't afford the extra however many thousands I now need to pay, and can we split it between the seller and the buyer, and all sorts of things like this. So have you had many people impacted by that, and how have you and they been dealing with it?
Zero, thankfully.
Oh my goodness.
Yes, I think that's it. I think it's another one of those, you only hear the bad news stories about it. Going back slightly about the budget, I totally agree. We were all bracing ourselves, weren't we? I had many a landlord calling me saying, right, I'm factoring in this, I'm doing that, I'm prepared, I'm thinking, right, doing absolutely everything. When in actual fact, we were bracing ourselves for the worst case scenario, and it didn't quite come. So when the whatever was put in place, i.e. stamp duty, which is the one which really affected us, it was like, well, okay, could have been worse. So all the information which was leaked beforehand was actually done quite well, done at the right level. It was going to come. You kind of look at it, how you can defend it, can't you? An extra 2% on additional properties. People appreciate it is a business. If you are an investor, it's part of the business. You factor that in. It is what it is. What do? You can't complain about it. It's not something you can fight against and hopefully get back. So I think that's here to stay. I'd be surprised if they change that any further anytime soon. So I think we can pretty much work with those numbers. And then So going back, have we been affected? Not one of our team and all of our none of our pipeline has been affected by it. Now that may be luck. I absolutely agree with you in what you're saying. I've heard the stories of immediately, right, I want some money off. Immediately, I can't afford this anymore. I think it depends on where you were down the chain, how far along you are in the process, and you negotiate along the way. We had an immediate meeting with the team and made those decisions, basically saying, right, okay, we'll look at each individual case and make recommendations accordingly, which will be go back to the vendor and try and work something out, because everybody knows it's there. It made big news, so it is understandable. But I don't think the market has been affected that much by it, and I'm not actually sure it will be going forward. I think in a lot of ways, it's a sort of sigh of relief. Right, that's where we are. Yes, we understand it. I can make a choice to invest or not going forward. And a lot of people, if you're into property, people are listening to this. You're confident enough to that within the mortgage market and within the property market to take that leap anyway. So it's just about the numbers. Now, this is another number none of us wanted. Of course we didn't. We don't want stamp duty full stop, but unfortunately it's here to stay. So it's factored in. We've had this discussion many times before. You factor the figures in. You can't. There's certain figures you can play around with. You can reduce. You can increase. Whatever. Stamp duty can't. There it is. It's here to stay. No point fighting it. Factor that in. Do the figures work on that property in that area for what I want to invest in? And I think that certainly from I've had the feedback I've had so far is, well, yeah, that's okay. Could have been worse. So I suppose it depends on how it's affected you, doesn't it? With the budget, there are different areas of the budget which has obviously affected people an awful lot more than this. And it's a choice. If no one's forcing you to buy a new property, but I think in time it's another one. It's a bit like the interest rate rise beforehand. People will get used to it. That's where it is. It's when they increased the stamp duty on buy-to-let and investor properties previously. All hell broke loose in our market. It was like, no one's ever going to buy a buy-to-let again. It's never that. That's it. Killed the market. Actually, that didn't work. People reworked the numbers. I think what happens is savvy investors, savvy landlords, then just work that much harder trying to find the right property. Diversifying in what type of property they go for. Should I start looking at HMOs? Should I start looking at student lets, multi-unit blocks? Should I start looking at commercial property, semi-commercial, flats above shops, flats with the shop underneath? All of these where probably wouldn't looked at before, but they're becoming much, much more popular and not dissimilar in a way to a standard one-bed flat, in the middle of town. I mean, it just is. The leases are fairly similar over a longer term, but once you get your head around it, you're like, okay, that makes a lot of sense to me. So there are a lot of different areas, and it's just being a little bit clever on the whole situation.
Yeah, cool. Well, that's much more positive again than I was expecting. This is turning out to be a very positive episode. I think something's gone wrong here, but but something else which is probably positive, depending on what else is changing. But you mentioned earlier the banks are starting to move away from the crazy fees, the sort of 7% and things. So what's happening there?
Absolutely. And again, another sort of not good conversation we've had over a period of time. They seem to be disappearing pretty much on the whole. There are a couple of lenders who have still got a couple of silly rates, but nothing where we were before. It does mean that rates have gone up, or from the lowest of low. Now, again, from our business, very, very few of those were used. We didn't really, because and I do think it was a bit of a marketing ploy. Look what we can offer. We can offer a 3.5% 5-year fixed for your buy-to-let. Wonderful, with a 7% fee. It never really worked out. When you had the conversation with someone, you say, we've got this, and eyes come out the top of your head. And think, oh, I've got to have that. And then you work it in, you go, actually, it's not quite very good. I don't think I'll go with that. And it didn't sit very well with me. We have products available to us to advise on, and it just didn't sit very well because you've got that at the end. You're paying interest on it. Very, very rarely do people, consumers, then pay the fee up front, and certainly not when it's 7%, when you've got stamp duty, you've got fees, etc. Not something they'll add. And of course, and all you're doing is increasing your mortgage from day one, because you've got that when we're looking to refinance in 2 years, 3 years, 5 years, it's there. Your capital's gone up. Doesn't sit. I mean, I know it. I appreciate that it does anyway if you put £1,000 or £1,500 fee, but that's not quite as bad as 10 or 15 grand. So yeah, rates are back where they were. I mean, if we were talking about, and I'll just touch on these rates, and we can just go back to somewhere like August. August had, with a limited company buy to let, you could have a 2-year fixed rate at 3.64. Really exciting, but it's with a 7% fee. Now, same product, 4.5%, 0.8, 0.9, somewhere there and there, with a 3% fee. So you'd have to crunch the numbers to see if that actually makes any difference. But what we definitely know is very different, is that you're not going to have the extra 4% of your loan amount put onto the capital at the back end. That's good news for everybody. I think a 3% fee. I mean, there are products out there with the standard 1,500. Which is pretty much across the board now. I think an awful lot of lenders have got into a bit of a groove. Some may say a bit of a rut with just throwing on a £1,500 fee. What's it for? We're still trying to work that one out after all of these years. But again, with the fee, I mean, they can sort of work the fee in to lessen the rate, I suppose their argument would be. But yeah, I mean, if you're looking something with just a standard £1,500 fee, you're looking at 5.5%, 5.54. So it's 1% higher. So again, anybody out there listening, make sure you speak to a broker. Make sure they work the figures out for you over the period of the fixed rate, so you know exactly what you're paying back. And if you just want simply the cheapest money out there, fine, no problem at all. You do that. I wouldn't recommend it, that's for sure.
Quite. So you mentioned a few rates there, but let's go through them methodically, as we often do. So I think we normally start with a sort of consumer interest rate, just to ground us, even though most people listening are looking more at the investor angle. But let's start with the consumer rates. Where are they at the moment?
Absolutely. Well, even though our lovely group of listeners are investors anyway, chances are there'll be a residential mortgage owner. Let's hope. Makes my life a lot easier. That's something out there. Lenders now, I diverse. This is an interesting topic actually, because a lot of buy-to-let lenders now. So if someone's listening and they want to get into the buy-to-let market, and they don't have a residential property, make sure your broker knows before they start doing any work for you, because there are a number of lenders out there, a huge number of lenders out there, who will not allow you to get a buy-to-let without having a residential property.
Interesting.
It's different in reasons, mainly because they think you're going to live in it. And if you have a residential property, there's not really the chance of you doing that as much. Of course you can do, but that's just a side issue there. Point. It's very helpful for me. Now, residential. So where are we? 2-year rates now, they haven't unfortunately dipped below the 4%, 4.09 at 75% loan to value. Pretty good. We're getting there. We're getting really close to that. I think that's sort of that level we'd all like to see it. But the 5-year rates there's a 3.89 5-year fixed out there. Would you go for that? I mean, that's the big topic at the moment. What are you going for? It's always, Simon, what are you looking for? What would you do? I would still at this point go for a 2-year fixed rate. Personally, that's where I feel we should go. You're not like tying yourself into too much. We're still expecting some base rate cuts, so I think that will come down. Tying yourself in for 5 years at this stage, unless you're really comfortable with that, not somewhere I particularly go. But that's I don't even think you can go far wrong. I don't think it's not something we're not looking at 2% rates anymore, or very, very much doubt it.
Yeah.
So tying yourself in at 5 years at 3.89, that's pretty good. And if you go to the other end of the spectrum, if people are looking and going, and they've got people who are buying, first-time buyers, and putting in, we're getting more 95% mortgages are becoming a little bit more common, because obviously first-time buyers, what they have to buy for, the prices, depending on where you are, of course, where you are in the country, it's so big. You speak of anybody of my ripe old age, and they were going, "Oh, well, I only had to put down £1,000 or £2,000, and it was all in, and those good old days and things like that." Well, those days are gone, and even 5% can be a lot of money. So 5% rates, 5.2 on a 2-year fixed, 4.9 on a 5-year fixed, which, if you're only he says only loosely, only putting 5% down, it's not. I don't think that's bad. I think that's much better than what we have seen. Banks have got a much better appetite for a 95% mortgage. They were really anti it for some time. They've really come back into the market quite aggressively now, and I think figuring out that the way ahead, the forward, as I said before, I think 2025 is going to be good. I think it looks good going into 2026. So I think the banks are more comfortable with it and where they're going to go. So therefore, they're not making them so ugly at the moment. So becoming a little bit more attractive, so more people are going for them. So that's good. Flipping over to where we want to go with the buy-to-let market.
Yes, indeed.
This is where we are. This is where we're talking about now. Interesting enough, the rates with limited company and standard buy-to-lets in a personal name, the rates had been very, very similar for quite a while. Now, if I look back in April, they were exactly the same. Now, that was a time when the fees were higher. Now, fees were slightly different be it with in a personal name and a limited company. They were always going to be more, but rates were pretty much the same. I look back in May, they were the same. They had a 3.74 with a 7% fee, 4.24 with a 3% fee. They were quite high. Now what's happened is we're seeing that there is a difference between the two. It's come back again, which is generally what we'd expect.
Yeah.
Again, however, so you have, for example, I'll talk about 5-year rates because, again, probably 95% of our business with buy-to-let purchases or refinances on 5-year because of the stress testing. So again, listeners, make sure you look at the stress testing. Make sure you can see how much you can borrow because it doesn't necessarily go on the headline rate. So there's a 4% buy-to-let rate in a sole name or joint name, personal names, let's say, £4,000 flat fee. Can or cannot, it may not be bad. But there is a 4.13 with a £1,700 fee available. So much more attractive now. I think they're coming, as you can see, you can probably see from that why we're probably a bit busier because that it makes it starting to get a little bit more aggressive and nice out there. So you can see where people are crunching numbers. Now, again, I'll probably look at refinancing of buy-to-lets for us can be a mixture of limited company and personal name because of that. That just goes back historically. If you've had them in a personal name, it's unlikely you're going to change over because of stamp duty, etc. It doesn't work out the additional cost. So if you're looking to buy in a limited company name, 4.94. So you can see it's quite a bit more now.
That is quite a bit more again, isn't it?
3% fee. Or there's a 5.19 with a £1,200 fee. So it's quite a jump. Now they've seen the limited company product seems to have stayed right up there. Personal name come right down. Now, what reasoning behind that? Again, we don't know. We never will. But where they're trying to make it more attractive, I certainly don't think the banks will ever push anybody into either making a choice between personal name and limited company. I think that they've got their own reasoning behind that. I think they'd be in a lot of trouble if they did. But it's interesting. I mean, I think that they're looking for the refinance market on buy-to-lets more aggressively than they want the purchases. They know that a lot of the purchase business is coming in limited company name. Therefore, they're pushing that rate up. So for whatever the reason they want for it, HMO multi-unit block slightly higher. They've got a 5. We can get a 5.11 with a 5-year with a 5% fee. Not horrendous if you're looking at an HMO, or a 559 with a £2,000 fee, flat fee. So again, nothing. I think the buy-to-lets in a personal name are they're quite attractive now. Limited company, not so much. Standard buy-to-let, limited company, HMO, multi-unit blocks, student lets. Yes, that their figures, I think, and certainly the feedback I'm getting from portfolio landlords I'm dealing with, they're going, oh, right, okay, yeah, we can work with those sort of figures now. So, yeah, I mean, that's kind of where we are. That's a bit of a roundup. I mean, and that's why you can see from some of those why we're a little bit more positive. Not like me to be that positive, Simon, as you know. I don't know. I must be getting into the Christmas spirit already. I don't know. You're getting early.
No, you can't mention that yet. It's too early.
Oh, yeah. Sorry. Yeah, it's far too early. But you can see from that, right, okay, everything's going in the right direction. And although I think all of us were really expecting the worst when it came to the budget, we've all, I think I said before, I think we've all taken a sigh of relief and think, wow, actually, that could have been an awful lot worse. Right, okay, what can we do going forward? And I think we've got a lot of people as a team who are waiting to buy. They're looking to buy. They want to buy. They want to put their property on the market. They're seeing what's happening. Right, because the budget, of course, could have had a huge impact on what is on the market and what's available. And I actually think it was, for us and for the market, it was actually a good thing that they brought the stamp duty in and changed it immediately, because there's no waiting around. There's no, right, okay, we've got to get everything done by that date, and then you've got solicitors doing huge amounts of work and they're rushing everything through. Right, it was done. Okay, let's move on. Don't be wrong. If you were in that situation, all of a sudden you have to find X amount more. That's not good. I'm not saying that at all. But for the market and actually going forward, right, that's there. Let's look forward. And I think people then have a better understanding, for the first time, I would say, in a couple of years, of the landscape of the property market going forward. And we all like to plan, don't we? We all like to know what's happening as much as possible. And it's damn difficult in the property market to plan, as we know, because you never know what's around the corner. But I think I just get the feeling, for the first time in a few years now, we can plan ahead, and we've got a better understanding of what that landscape looks like and where we're going to go with it. And I think that's why we as a business are, we're all fairly positive of things going forward. We're seen by the activity we've got jumped up significantly, and we're expecting that to happen again as people have settled in after the budget, and when with the expectation of the lenders dropping rates at some point. They will come out with a fanfare. I have absolutely no doubt. Again, Santander, boo. We don't like those putting rates up immediately. What are you doing, Santander? But they will come out with a fanfare like everybody else, and drop rates again. And they'll be up there. I'm not just having a go at them, because they're wonderful, honest.
Cool. Well, I think that all sounds really fairly positive. I mean, some of the rates are a bit higher, but you say the fees down, so overall fairly good. And as you say, it's a really quite positive sounding outlook for the future. So,
absolutely.
Thank you very much.
Let's not get used to this, Simon.
No, indeed. If anyone wants to speak to a very positive Simon Glastonbury quickly before that positivity runs out, then his contact details will be in the show notes. Make sure you go and find those, and he will be very happy to talk to you about mortgages and all sorts of related finance things. Yes, catch him while he's positive. And I will be back again, maybe just as positive, maybe not so positive. We shall see next week.